Daisy. Let's see what there is in the freezer. Feel like ice cream? Oh, hi there. Thanks for tuning into my channel, All Things Accounting. This is my special helper, Daisy. She loves ice cream just as much as I do. So, I wonder sometimes what kind of depreciation method does ice cream factories use for their equipment. So seeing as how this is seasonal, well, maybe there's a better way than straight line depreciation or the other types that we've discussed before in some of my other tutorials. So stay tuned and we'll get through this together. Ice cream, if we look at ice cream, certain ice cream factories have specialized machinery and equipment to make it. Seeing as how it's more seasonal, then it would make sense that these ice cream factories would make more ice cream and sell more during the spring and summertime. And whereas in the fall and winter tends to be on the down mode. So accordingly, it would only make sense that the depreciation method that these companies use would most likely coincide with how much output that these equipments are producing. The more ice cream that it produces, then the more depreciation expense would be recognized on the books. So we're going to be going through activity-based depreciation on the whiteboard. So if you want to follow me, then we'll go through this together. So if we're going to be talking about activity-based depreciation, there are certain keys that we should note. Okay, so we can say that activity-based depreciation allows businesses to better match expenses against usage levels. So what does that mean? The more you use the equipment, the more it produces, therefore the more expenses has to be recognized in order to better match with the revenues for which it was used to generate. So in this case, it focuses on the usefulness of the asset rather than just spreading it across over time, like say straight line depreciation or accounting for based on a certain percentage. Here it's a little more accurate because if I produce more, I use more of that particular fixed asset, therefore I'm using it up faster, and therefore I should recognize more of the expense because hopefully I'm using more to generate more revenue. So here, the output level from the asset directly relates to the expenses incurred in the production. So what's the formula? What can we derive a formula here? So depreciation can be calculated as the original cost less the salvage value. So far it looks like the straight line, all over the estimated total output. Estimated total output multiplied by units produced. Okay? So what I'd like to do right now is run through a numerical example with you, just to solidify our understanding. So let's say ABC company buys a food processing machine or equipment for $130,000, and it has an estimated output potential of 1 million units over its useful life. The salvage value is estimated to be approximately $15,000. So, what can we do? If 150,000 units are produced, then how much is the depreciation in this case? So we have all the pertinent information that we need. So depreciation here would be 130, the original cost, less the salvage value of 15,000, all divided by the potential output, which is 1 million, multiplied by the units produced, which is 150,000 units. Okay, so if we compute that out, it would be 17,250. So on our books, to account for this, we would have debit depreciation expense for 17,250, credit accumulated depreciation for this particular machine of 17,250. And down here we would have the explanation. So I hope that makes sense, and I hope you found this to be useful. So there are 4 types of depreciation methods that I've gone through in my other tutorials. So in total it would have been straight line, the declining balance, double declining balance, and the last one here, activity-based depreciation. So I hope you enjoyed this. Please remember to subscribe to my channel, hit that like button, and hit that bell notification icon so that you're always up to date on the new tutorials that I'll be uploading. Until next time, take care.